If you're a 112 trader, you're probably asking yourself, where do I go from here? Volatility spiked over 300%, causing most of us to stop out or at least massively mess up our positions because of how much buying power was being taken up that we had to close some things to stay in trades. Anyways, as a 112 trader, there's a lot of risk that goes into the market, especially when we're trading at all-time highs. That's the exact question that one of the people on my recent Q&A asked me. Austin, as a 112 trader, how do I continue from here? And so I'm going to share the recording that I did from that meeting to walk you through step by step what you need to do as a 112 trader from here to continue to profit, but also massively reduce your risk. And hint, it has something to do with this chart. So let's dive in.
If I'm gonna do this again, I'm just play with MDS for maybe a year or so. So
Mhm.
would you still recommend, 112 with MDS or something else?
Yeah, so I think MES is fine if you understand that you're not gonna always have a stop loss on it.
Hmm.
In a normal market, and I say normal, like 2020 two, the market slowly sold off. I mean slowly. There were a couple 2-3% days, but I'm talking about the volatility. It was very normal. And so a stop loss in that scenario would have easily been covered. But the fact that this happened and MES is already a lower liquidity asset, all the volume just went away. And so that was the issue. But anyways, I say that to say I pulled up the VIX chart to talk about like how to look at it going forward. Um, and again, you can pick your own number, but let's just, for this example, say $15 is the number, okay? So if we're trading on VIX below $15, $16, let's say that we only use 25% of our buying power. I say that because, again, I have access to a lot of the trading data, which is cool. And I saw that um, for the people who held through, the buying power increased about 150 to roughly 175% of where it was trading. So that means, if you were trading at, if it took $1,000 of buying power, it jumps up to about $2,500 roughly. And so what you're looking at in that scenario is the key reason that is not only because we had a super huge spike, but also because the VIX was so low that there was no buying power risk factored in. And so one way to withstand this is to change your buying power allocation based on VIX location. And I say that as in, well, before I say that, let me say that if you would have held through the 112, like for instance, Lorna did and a couple of others did, because they understood a spike this big and volatility will not last long. If we look at it, it's this one even took a bit to get up there, so that's why it lasted longer, but it still didn't last too long. But a VIX spike that big just can't last that long. And so they just let the market reset. And so all their 112s are back in profit already because of that. And so they were able to do that because of buying power. And so if we can hold through our trades longer, then we can avoid those types of losses. And so the question is, how do we manage our buying power better? And so again, in general, a 50% rule is really good. If we have a 200% stop loss, that makes sense. By the time we hit our 200% stop loss, we're around our 100% account value if we started at 50%. But if we want to hold through, then we need to have more buying power available. So something that I'm looking at is like, hey, if VIX is under $15, which means volatility is very low, maybe only trade with 25% of your buying power. I say this because we saw, or as I saw, volatility, or I should say the buying power requirements go up about 100, 150%. So if you're only trading with 25% of your value and it goes up 100, 150%, I should say 150 to 200%, well, now you have about 75% of your buying power being used. And so now you still have extra cash left over, and now you have room for this buying power to adjust and for you to stay in this trade longer, to see it through and to let the volatility reset. So I think something moving forward is looking at where is VIX and adjusting your buying power allocation according to it. And then again, if we're over this level, you could get closer to 50 because more risk is baked in, so it's not going to go up as high. Again, you can do that for what you wish, but this is just kind of like ways to continue to sell options, whether it's on MES, ES, whether it's a 112 or just a straight up short put. Just kind of basing how much money you allocate to that trade based on your Vega risk, essentially. Did that answer the question or no?
Yeah, kind of, but going forward, how are we going to still stick with our 112 MES the way we do hedging? Yeah, or are there any changes on strategy wise after
Yeah,
this week? What
yeah, for
happened
sure.
this week?
Yeah, so I would say step one is doing buying power based on VIX, because that's going to save you a lot of headache. And then outside of that is hedging. And so when you do hedging, there's a couple of ways to do this. I can't spell, so I'm just going to call it HD, whatever. Is again, if we're trading around an all-time high, so like a very risky resistance level, the market all-time high. Meant to do the high set. I don't even know how you set ATH, maybe. All-time high. Versus normal market. Terrible acronyms, whatever. If we're at a higher risk, which is basically based on VIX or based on where the market is, we want to have more long puts. So for instance, a couple weeks ago, we would have wanted to do that. And so I say long puts by, we can do a 3-5. We can just close when we get to a 112. We can simply just close all of the short options we have instead and leave that one long put. Or you can just go out there and buy, a single.
Yeah, I think in one of your video, like probably 2 weeks ago, you mentioned that for ES or MES, long put 45 days with a certain delta. I think that was one of your response in your Discord group.
Oh, probably. Yeah. Yeah. So, I mean, if we look at this, when the market's trading at all-time highs, because that means that at the same time, VIX is very low. And so outside of adjusting our buying power for VIX, we should also adjust our hedges for it. And so that means, like I mentioned, step one is controlling your buying power. And then step two is if we are at a point where VIX is really low and the market's just continuously all green days on an all-time high, then you want to have some long puts, whether that's a super far out of the money 7 DTE out of the money put, DTE, that's a long put, or you just close all your short positions and leave you with just that 1+1 on the 112. Either way, having a long put when you're at an all-time high level would have helped a lot in your buying power and your intraday losses for this type of event. So moving forward, same type of structure. If you want to take less risk, do MES, or if you want to still trade ES, but you want less risk, move to a 111. It's going to be roughly the same trade structure, same win rate, but you'll have half the buying power risk. And then, just base your hedges and buying power off of VIX.
I see.
So Austin?
Yeah.
Did we really get stopped out with because of our buying power loss, or was it we got stopped out because it hit our stop loss on profit loss?
Yeah,
like
so we
200%.
won't stop you out for buying power. We'll only stop you out for the rules that you set, which is whatever that is.
Okay.
All right, Vera, do you have any questions before we jump to others back again?
Yeah, sorry, I joined late. I see this recording. Where are these recordings available?
Yeah, I end up putting it on my YouTube channel. So either the Options Auto Trader YouTube or the main channel, depending on.
Okay, so and the links for this Zoom call is only on Discord or somewhere else?
Yeah, it's on Discord under the
Events.
Where is it? Yeah, events.
Yeah, it took some time to figure out where.
Oh, sorry about that.
That's fine. And when you say that, okay, adjust your buying power based on VIX, what are we adjusting? Actually, the buying power that we allocate to the 112 trade on the auto trader?
Correct. Yeah.
Okay.
Yeah, so saying like 25%. So typically, just for easy numbers, let's say you have $100,000 account. We were saying do no more than 50%, which I would say now that's fine because of how high VIX is. So it's already baked into it. So that would have been around $50,000, which is fine now, I think. But when VIX is down around $5, $10, that Vega risk is really high. So instead of doing that, maybe go closer to $20,000 allocation for the 112s.
Okay.
20, 25, something like that.
I guess my issue with that is that you've got a lot of cash there not earning you any money, right?
Yeah, that's true. You do have to understand that, yeah, you don't, but at this, I mean, and there's ways to deal with that, which I'll cover next. But the first thing is this 20K is still making you a lot of money. I say that because these trades take about 45 days. And so every 45 days, we're making about a 12% return on that money. So despite the fact that we have a lot of extra cash, we're still making 12% every month and a half, which is very good. So this money is making 12%. And so again, if this is only 20% of that, you're still making around a 3-4% return with a very low amount of money. But then that's which is the recent discussion that we had in Discord, which is about like something like T-bill, which is where it's I believe it's the 3-month Treasury bond asset, which I mean it varies based on what the interest rates are, but it's very stable.
Is that liquid, or is that you have to commit for 3 months at a time?
Yeah, no. So this is a tradable ETF.
Okay.
So you can get in and out of it whenever you want, given the market's open, obviously. And so again, the way that you would structure something like this to kind of help with that is, so for instance, here, let's say we're only doing 20% on 112 because we're afraid of this Vega risk. Let's say volatility is at $5, so the risk that is very high. So we're only using 20% here. Well, then we could get closer to maybe like depending on how much you want to do, but 40 to 50% could go into T-bill.
Mm-hmm.
You still want to leave some for when the buying power needs to increase for the 112 trades. But if that starts to happen, like the market slowly starts to sell off here, then you can see that coming, and so then you can slowly cut this trade back to 20% and then keep cutting it back as needed so that you can free up buying power for this. But in the meantime, this extra money is making 5% a year, or if you only keep it for a month, it's 0.4% or something like that.
Okay.
Yeah. But yeah, so I guess the key thing is here, just make sure that you have enough room for the 112s to expand before you have time to take off T-bill positions.
Does T-bill pay you monthly?
Yeah, monthly dividend. Yeah. So it's about 0.4% every month, I think, or something similar.
That's good. Good to know.
Let's see. Oh, here is the detail.
Can you educate me a little bit about the VIX? Because
Yeah,
I thought
for
when
sure.
the VIX was low, that's when we had less volatility.
I mean, I don't really know how to say that other than that's wrong. Sorry.
Okay.
But yeah, no, when VIX is low, volatility is low, because VIX is volatility.
Yeah, right.
VIX stands for the volatility index, so VIX. And so you can see here, obviously during major crashes, that's when volatility is high. And so you
But
can
the
see
VIX jumped up too, right?
yeah, the VIX jumped up over 300% in a single day, which from a
Well, it was up around 65 or 70.
Yeah, it got up here to 65, 66.
Yeah.
Yeah. And so this is what most of the issue was with the 112 trade. It wasn't necessarily where the market was, although that would have hurt because the market was down, but the main pain came from this VIX. And so again, this is something we do need to understand and do need to account for, but also at the same time, we can't let it scare us out of not taking trades, because this was an event. Tasty Trade did research. I think it was David who shared it or somebody else in the group, where this was like ranked in the top 10 for the last 30 or 50 years or something. So this can happen, but it's, this is a very rare case. But it's still something, we need to be aware of and be able to, plan for, which again is more like if VIX is down here very low, and we're at all-time highs, maybe just having more long puts on,
Okay.
and then, dialing back our buying power. But also another way to do it is, we always aim for an 80 to 90% profit, on those trades, which is very good. But an event like this, it could be a little far reaching. And by that, I mean, remove drawings. By that, I mean, we know that VIX is really low and that we're reaching all-time highs very quickly here. And then we see the market start to sell off. And by that time, I know we have some trades that are maybe around 10, 20% profit, something like that, on the very low end of profit. Well, we can understand that, hey, the market's starting to come down and VIX is really low, so the chance of us crashing and seeing a volatility spike is higher. So maybe I'll take off those small winners to free up buying power to allow my really good trades to stay on.